We like to use short-term rentals as a strategy because we're able to realize higher gross revenues out of the properties, and we're able to quickly adjust our nightly rates to keep pace with the volatile market and the inflation that we're seeing in the economy right now. We like to find properties that are in very desirable locations that are walkable to bars and restaurants. Typically they're brand new or like new properties that don't require much maintenance, that are very modern and unique, that have unique amenities like a rooftop or a very nice yard that attract renters to our property specifically over our competition. Short-term rentals are a good strategy because you are able to adjust the rents that you're charging to tenants on a nightly basis versus a lease where you're locked in for 6 or 12 or 18 months at the same rate with the tenant, regardless of what the economy and inflation is doing. Long-term rental strategies require a little bit less hands-on maintenance. Generally, the tenant is going to take care of some improvements on the property, or they're going to be locked in for a year or more, versus short-term rental, you have returns almost every single night in a month. You have to hire a property management company that's going to be a lot more hands-on than a long-term property management company, and you have to manage an active listing on Airbnb or Vrbo like a hotel versus a long-term rental where you have a tenant in there for an entire year that you just sign a lease and forget. Short-term rentals see about a 3x multiple over long-term rentals on average. For a long-term tenant, you might get into a particular unit for $3,000 a month, or an Airbnb or a short-term rental, you might be able to get $9,000 or $10,000 out of that same property in the same month by renting it on a nightly basis. So short-term rentals generally have higher expenses than long-term rentals. We pay a platform fee for Airbnb. We pay cleaning expenses for every turnover that we have with the guests. It also translates to higher net income than a long-term rental because we're seeing higher top-line revenue. Even though the expenses are a little bit greater, we're still seeing higher net income. Long-term rentals in this market, generally, you're going to be breaking even with the rent that you're collecting and the expenses that you have. Short-term rentals, we're seeing anywhere from a 15 to 20% margin on the net income. We buy properties that are close to bars and restaurants, that are very walkable, that are close to attractions in any given city that we look at. So Dallas, our properties are fairly close to all the convention centers and the hotels that are located downtown. They're walkable to a lot of the popular bars and restaurants that are in Dallas. We try and focus on places that are central locations to the reasons people are traveling to our markets. So we make money through the net income of the properties from the nightly rentals. That net income ultimately translates to a return for our investors at the fund level. And we also make money from the appreciation of the properties. We've identified areas that still have long-term potential for growth, and we'll capture income and a return based off of the appreciation of those properties as well.